Are we okay? So as price was pushing to the downside, right? We broke below a specific key area. Remember that if we break in below a specific key area, which is this swing low, now when price is pushing to the downside, people are forced to exit their positions. Therefore, they are forced to liquidate their open positions, resulting in if you bought, right, and you're liquidating your open buy positions, now the health of your account, it's in question, right? Now you shift in perspective, you're taking those short positions. Again, when the market retraces, you're forced to liquidate your sell positions. Now the health of your account, again, it's affected. So how do you determine the liquidation pressures that are required for you to be in a position to initiate your trades, right? It's by understanding the psychological behavior of traders, right? Especially those that are using technical analysis, because you have to understand them. Okay, are you okay? We spoke about initiation of trades as a matter of probabilities, isn't it? The probabilities here, they say that the market has retested for the third time, resulting in an increase in probability. And if you can pull out the Fibonacci retracement tool, you can actually see that this is a 30% Fibonacci retracement level, give or take, right? 38.20, 38.60, I mean, 30% retracement level, giving you the necessary required probability for you to consider taking those long positions. But yet you fail to see that at this current market, if the market is declining in value, what is propelling the market to push down? It's due to the liquidation pressure coming into the market. Remember, as the market breaks below this level, the liquidation pressures of those that have taken their long position increases. Now they are forced to liquidate their open position and shift in perspective. Now, price, when it's retracing, they are forced now to liquidate their buy position, resulting in this aggressive push to the upside. But in the very same sense, you take into account that there is someone that is located above here or located at this area here, taking short position upon the retest of the level in which the market broke out of. And again, when you view it, you can see that this is an impulse. Now you are in a corrective phase. This is the push to the downside, is the last leg of the impulsive phase, resulting in the liquidation. So for us, we were looking for a bit of a deeper push to our upside before we can have a decline in price. But unfortunately, that didn't occur, resulting in the market having a strong push to the downside. But either way, this was the level that we were looking forward to initiate our positions. The reason why we wanted to initiate our position at this specific level is because of the initiation, is because of the liquidation pressures that arises when the market breaks below a specific trend line, resulting in more traders shifting their perspective and looking to take short positions. As price continues to push a bit further to the downside, the minute it retests a level in which it broke out of, the initiation pressures increases based on probabilities of based on increasing probabilities of technical analysis, or the use of technical analysis results in people having more justification in terms of them initiating their positions or their trades, right? So we saw the market pushing a bit down, right? Retesting the level in which it broke out of and rejecting that specific level. Therefore, confluencing with the retest of what? The 61.8 Fibonacci retracement level, which was used or which was drawn based on this. What is this? We're talking about this level here. Do you see? It was based on the 61.8 Fibonacci retracement level, the retest of the level in which the market broke out of, that gave traders more assurity in terms of the rally. But again, how do you, when you're plotting your Fibonacci retracement tool, do you think when you're using your Fibonacci retracement tool, do you think you're using it the same way as the next person? How many people are drawing it the very same way as you? Some have it here, some have it here, some have it here, some have it here. The swing lows are different. Some have the swing lows here, some have the swing lows here, some here. It all depends on how you view it. It's a matter of perspective. Yes, it's a subjective tool. The use of technical analysis when approaching the market is subjective. The reason why I didn't consider taking long positions at this specific area here is because I understood that right now, as the price pushed to the downside, right? This retracement, it is a corrective move. So for me to be in a position to start profiting from this push to the upside, I need to see the market making a bit of a deeper push to the downside, right? Because the reason why I'm seeing a bullish candlestick formation, or the reason why I'm seeing the retracement, is because of what? This. You can put it there and put it here. Doesn't really matter that much. Still a technical tool, right? It's a matter of this. It's a matter of what I have seen, right? And when you put yourself in a position where you understand the psychological behavior of retail traders, it gives you added advantage. Because we're saying that the use of technical tools or the use of technical analysis for us, right, is to locate where the net losers are located. We're not using this to find trades for ourselves, but we are using this in order to understand the psyche or the behavior or the behavioral phenomena. You see, now this is big English now, hey, of retail traders, isn't it? Are we okay? Oh, we'll finish this tomorrow. I think everyone has had enough today. You see, now we down to 50. The 3 are gone, so that means they're tired. Oh, now when we're coming back and then we're looking at the market, right? The most important thing is understanding what traders are going to do. So the break below the specific level, what do you think traders are doing? Those that have taken their long position at the specific area, right? The same situation that has occurred here, how is it different from the same situation that has occurred here? Is there a difference though? The same situation that occurred here and the same situation that occurred here, is there a difference? Remember that this is a swing low. This is an area of significant. It got broken. The retracement, we know that the objective of a retracement, or the reason why we are seeing a retracement within the market, is not because like it has to be there. No. It's because that traders are being hit in the process of that break below the specific key level that they viewed as an area of importance. So when the market breaks below an area of importance and continues to decline, those that have holding on to their positions, remember, we said that there are two things that are currently, that are important: the initiation of trades and the liquidation. How you choose to liquidate and initiate your trade gives you an added advantage. For example, there's a guy that was holding on to some things for a very long time. He initiated them. He had reasons for initiation, but he lacked reasons for liquidation, resulting in an increase in drawdown upon to a point whereby the account is no longer there. He had hard rules of initiation, but lacked hard rules based on probabilities to initiate his was it buy positions, yes, but he lacked the liquidation, right? Action. He lacked the action to liquidate his positions, resulting in an increase in drawdown. And you know, when the market is in a drawdown, let me tell you something about the difference between a live account and a demo account, right? A live account, hey bruh, the charges within the brain, the brain activity, it works. You are in constant conflict with yourself. Even I sometimes be in conflict with myself. Oh, should I close? Should I hold? What? You are in constant conflict with yourself when it comes to a live account. But when it comes to a demo, why would you have conflict if the money is not really there? There's certain things that can be taught by a live account that demo can't even tap into. Because once you put your money where your mouth is, or you put your money where your analysis is, then you get to see who you truly are. It will expose you. A live account will expose the type of person you are. Because it gives you the opportunity to make action on your open positions. You're looking at it and say, hey, I'm in a loss. Now you're going to let it run again. You have not, like, you're going to let it run in hopes of seeing the market retrace, right? Psychologically speaking, when we study you, we say we're studying your behavior based on how the market behaves. When you see a drawdown, how do you close your price? Do you close them or do you hold on to them? Now it's a matter of feelings. How are you feeling when you see an increase in a drawdown? Are you going to take a decision? Remember, liquidation is a matter of action. Are you going to take a decision and close that position? Or you're going to let your feelings dictate how you're going to behave within the market? You see now, we're just analyzing. Say, oh, okay, sure. I'm going to let it run for a bit. You see that drawdown continuously increasing. And deep down, you know that you're here with a drawdown. And you would see that the probabilities of price coming here, they are there. But you continue holding. You see, when a relationship is dead, but you guys want to be there because people are seeing that, you know what, these guys, they've been there for a very long time, but you guys are suffering. This is the same situation. You suffer in silence. You don't want to let go, but you know that this thing is gone. But you can't let go, man. You're there, man. You're here. You're taking those short positions. You're holding on to them. You know that this will come. The probabilities of price coming back to these areas are there, but you don't want to go there. You don't want price to go here because, like, you feel like you have a certain entitlement on how the market should move, instead of putting probabilities on your side and say, you know what, the probabilities of price dipping a bit further to the downside, they have increased. That's why you end up having a 17 rand account, because the market has finished. You can move from 500,000 to 17 rand quick in a hurry. The distance between here and here, hey, we established that it's called 164K, and it was. I'm not talking about anyone. I'm just saying, like, in terms of contact illustrations. Amen. Forex is it's a dangerous game, guys. If you don't allow yourself to liquidate positions, especially when you see, you're going to say that the market it's bad. You will be adding more sales at this particular level here, because you are hallucinating, illusions. But let's move away from that. So we're saying that the very same principle that has occurred here. So now when you see the market breaking below this specific key area, let's now look at it in terms of the closing price. When the market broke below this area here, it came back to retest the level in which it broke out of. The retracement was due to the forced liquidation. The very same principle can be seen being applied here. A retest of the level in which the market broke out of. What do you expect upon the retracement? Upon the retracement will occur. Obviously, there will be a push to the downside. What is the main objective of a push to the downside? The main objective of this push to the downside here is to liquidate those that have prematurely entered their long positions. Then upon the completion of the forced liquidation phase, that's when you will start seeing the market changing in direction, because we have established that the market, even though it drops in value, it won't be in favor of sellers forever. So the market shifts between a period of balance and imbalance. Are we okay? So this level here results in an increase in probabilities for one to take their long positions. This is not because of the fact that the market is retested a supply zone. No, guys. Remember that the use of supply and demand zones is just to have a clear understanding of where we can locate the shift in, where we can kind of like depict or kind of like try and pinpoint where you understand, where the imbalance can occur. But basically, we're just using logic in terms of approaching this. We're saying that, like, okay, this market has been dropping in value, and we look and we assess the bodies of the candlesticks, right? We say, like, if the market is pushing to the downside with a strong momentum, what is actually stopping it from reversing? Is because the only thing that can stop the market from pushing a bit further to the downside is by seeing traders coming into the market and doing what? And placing short positions based on the broken levels and the retest, right? And based on the momentum as well. So this is still a technical tool, right? But it kind of gives you an advantage in terms of, hey, this is where I can actually look for my long positions, right? Now let's come into this area here. So right now what we're saying is that, like, we currently look into